Well, my research was in why the British in the 19th century, why the foreign investment was all in bonds and loan stock instead of equities. You know, superficially you'd think, well, why didn't Britain come to own the equities of the new world? And something to do with what investors felt was optimal behaviour. A sort of risk aversion thesis, really, with all the complications of trying to understand what we mean by risk and uncertainty and probabilistic futures and so forth. And it led to portfolio analysis, which was a natural for me, my dad being manager of a stockbrokers in London in my youth. What happens when we introduce limited liability? I mean, to define it quite simply means that I can only lose what I've paid for the purchase of the shares in a particular company, and they may be worth nothing tomorrow, but at least I don't lose my house and possessions and so on. They're not at risk. My liability in the investment is limited to what I've paid to be in that investment. And the result has been, of course, huge companies compared to sole traders and partnerships that would otherwise be the norm for business structure. In some ways, a tremendous leap forward in structuring financial investment and real investment, raising enormous sums of money, of course, for huge capital projects. The investor himself, of course, protecting himself by just having a variety of different assets, ideally that are not too well correlated with each other in case everything goes flat at once. And you don't want that to happen. You want the situation where, well, there are some wins and some losses. Overall, I'm making good decisions in what I'm investing in. That's the sort of risk-averse strategy of managing uncertainties in the market. We have a portfolio of financial assets, bonds, different equities, different bonds, variety of real estate. And so we conceptualize the wealth holder's problem as how to safeguard his wealth and at the same time bring some sort of acceptable return from his point of view. It was, superficially at least, found to be, in the 19th century British case, to lend to foreign governments and buy really safe assets as well in the business field, such as railway, loan stock, bonds. So basically investing in something that's government bonds, in safe governments therefore. That's rather important from your point of view. And safe industries that perhaps you know something about, and the British were up on certain engineering things like railways and very happy to invest in that, much more cautious when it came to new industries. We let the locals fund that and see how they get on. So what happens when we introduce equities into our simplistic model so far? Well, foreigner might not be lending to your growth industry as he sees it with good returns. He may be buying your shares. Now, we get questions of political sovereignty coming in here. Do I want foreigners owning the industry in my country? That can be quite a contentious issue. It might be very clear when it comes to something like property, land rights. You may have a rule that says, foreigners can't own your land. In some sense, that's selling bits of your sovereignty. There may be sort of all sorts of compromises, in theory at least, such as, the land's not strictly speaking owned. You have a freehold, the right to hold it, but it's all owned by the state or the crown, Ultimately, they have the right to charge rates, and they could charge a rate that charges you out of existence, couldn't they? As they put the property rates up, both on buildings and on the land, market value of your property drops. Your expenses greater, of course, as a business, and squeezes your profits, may put you out of business. So, in some sense, the state is protecting its sovereignty, even though superficially it's allowing you to own the land. Sort of. Well, that may or may not be good enough from the state's point of view. It may simply make a rule that the foreigner can't own. And it could make a rule you can't own equities as well, and stocks and shares. This might, will mean, of course, less of a capital supply to new growth industries in your economy. And that could be costly. So you might not want to do that. And if you don't, and you allow the foreign shareholder to own some of the shares of your companies, what does that do? He buys shares in your company from, for argument's sake, a new issue. He presents his currency, buys yours, and with your currency, then buys your shares from your company making the new issue, or shareholders in your company, in your country, selling their shares to him. So the exchange rate has appreciated as the purchase goes in, and he now has a right to some of the rewards of that business. The foreigner has the right to dividends and so on. And that money flows out. That slightly offsets into the future the exchange rate rise. And of course, if he sells the shares back to someone in your economy, then we get the reverse going on. So if the world rushes to own your shares, your exchange rate appreciates rather dramatically if huge sums of money get presented for exchange. And if there's a steady flow of such and it continues to keep, they keep buying your shares and so on. There's expenditures each year on by the foreigner buying your equities and bonds. Then the appreciation in your currency means that you buy more foreign goods because you can buy their currency so cheaply now. And exports from your country tend to be choked off because the foreigners now are finding it very costly to buy your currency. So that may be counteracting some of the benefit of investing, buying the equities of, especially, of course, your export industries. Okay, so this is another complication on the balance of payments overall, isn't it? That we've got not just imports and exports of goods and services, but we now have capital flows, finance flowing in, loans, and also financial investment in stocks and shares of your country. Now, if you've got a volatile international currency where these capital flows and equity flows, well, they're all capital flows really, keep impacting your, variably impacting your exchange rate. This is, your local economy at home is being massaged rather dramatically. You might want to protect yourself against such volatility. It's not, well, it can be an endemic problem for some countries. In a sense, especially in what we consider those that tend to specialize in exporting consumer goods, where they're luxuries in a sense. They're not the necessities of life. In other words, your imports of food might be pretty constant demand, but your imports of I don't know, McDonald's burgers might not be. I'm picking on McDonald's, that's not really fair, is it? But, plastic toys and so on, perhaps that can kick around according to what you think your disposable income is. And when things are all good, you're spending, and when things are harder, you stop buying such and so forth. So you could be plagued by the volatility of the international interest in, well, also goods to do with construction industry. If there's a boom in the world, the general world economy is doing strongly, then there's capital construction going on, demand for those raw materials escalates, and in a world slump, demand for those goods really slumps. And if you're in that sort of export industry, your economy is affected accordingly, especially if the export industry is a large part of your economy. If we're thinking of something like Australia, for instance, that might be dependent heavily on mining, and that assume mining is something that is basically for rebuilding capital goods like roads, dams, airports, and housing and construction industry generally, then you're very much at risk of world booms and slumps. you might want to intervene in your economy so that you're less at risk and well, and that your society is a bit more economically stable, which means politically it might be more stable too. You know, it's very costly managing a country that's got dramatic unrest going on. Thank you, Heavenly Dad.